I think that what's going to be happening is that the dollar is going to break, right? And when it breaks, it's going to break hard. And again, that means that people have to get better prepared. That time is running out.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
I think this is a great time, to be buying here. Gold is not breaking 1900. I mean, it closed the week around 1925. I really haven't seen it trade below 1900. So it's in a very narrow range. Yes, it didn't hold 2000. And so a lot of people got bearish on gold because it didn't hold 2000. So what? It's holding 1900. Gold is holding up despite the fact that everybody is optimistic on the economy, optimistic on tech, optimistic that the Fed has gotten the inflation genie back in the bottle. There's all sorts of optimism out there and very little interest in the price of gold or buying gold. And despite all that, gold hasn't gone down. And I think it's holding up a lot better than people give it credit for. And we're getting ready for a big move up. So I think, this is a good time to be buying at this price. I don't think you're going to get much lower prices. If you're trying to wait for a low price, I think you're pretty much in the neighborhood of the bottom. And so this is where you should be buying your gold, more, even your silver, even more so. I see more upside in silver than gold, but I see upside in both of those metals, and buy some physical gold and silver for those of you who are risk takers. Right? If you want to try to, make 5 or 10 times your money or maybe more, the way to do that is not in physical gold, but in the mining stocks. If the price of gold does what I think it's going to do, then we're going to have an explosive rally in these mining stocks. And nobody is buying these stocks. I mean, the sentiment is very negative in the sector. People are still chasing the tech names or now the AI names, but nobody is paying attention to the real inflation trade. Nobody is buying the senior miners, let alone these junior miners. That's what you should be doing. Right? You need to be looking at where the big money is ignoring, right? That's how you end up making a lot of money as a speculator. You got to figure out what the crowd is missing, and then you got to get to where the crowd is going to ultimately be before they arrive. I know eventually the markets are going to figure out what I know. They're going to come to terms with the reality of higher inflation. It's going to be reflected in the bond market. It's going to be reflected in the gold market, the dollar, and it's ultimately going to show up in the price of mining stocks. So the crowd is going to figure this out eventually. And when they do, it's going to be a stampede, right? And they're all going to be, running into one another, bidding up these prices. There aren't a lot of mining stocks out there. Even if you added up all the market caps of the whole sector, you don't even get one decent S&P 500 company. I forget the combined market cap of all the gold stocks, but it's very small. And even if the institutions that are out there, the pension funds, the endowments, the hedge funds, if they just want 5% allocation to this sector, it's a game changer. Probably even 2%, 1% would be huge, because right now it's practically zero. So there's really no interest, even though there should be tremendous interest, because again, we still have faith in the Fed. People still believe Jerome Powell. They believe, everybody else on the FOMC. When they say they're going to bring inflation down to 2%, they believe them. They still don't get that they're going to say that regardless of what they're actually capable of doing. But the other way that Powell is not serious about bringing inflation down to 2% is that he's saying nothing about the budget deficits. He's not telling Congress to cut government spending because there's no way that inflation is coming down to 2% unless that happens. And Powell has got to know that. His job is impossible with $2 trillion budget deficits and $1 trillion trade deficits. There's no way. Inflation rates are headed much higher unless we have massive cuts in government spending. And that's not going to happen. And it's especially not going to happen if you have a weak Fed chairman like Jerome Powell, who is afraid to speak up and tell Congress what they need to do and what they need to hear, and that they've got to reduce spending significantly. They're still spending, like it's COVID. We had this huge increase in government spending during COVID, and while it's come down quite a bit from the extreme levels that we got to, they didn't return to the levels pre-COVID, and they were extreme too. We were spending too much before COVID. Now, we're even spending that much more after COVID. In fact, let me look. The national debt has been really starting to move. Let me look at the national debt clock. I just want to take a look at that and see how much higher it's gone. Hold on. National debt clock. You can see this clock on the internet. Nobody really pays much attention to it anymore. I forget when they first put it up there. Yeah, look at this. We're now almost at 32.5 trillion. We just passed 32 trillion like a month ago, because we're at 32 trillion 476,000. We're going to be at 33 trillion before the end of the summer. I mean, this could be the quickest trillion we've ever added to the national debt. It might only take like 3 months for the national debt to get up there. So it is just spiraling out of control. How is there any hope that you're going to get inflation under control? In fact, if you look at the historic relationships between the US dollar and the budget deficits, when the budget deficits are rising, the dollar is falling. And that's exactly what's happening now. Budget deficits are exploding. The only thing that's been keeping the dollar up has been the rate hikes, and the idea that the Fed is going to keep on fighting inflation and do whatever it takes, and it's going to keep on hiking rates. Well, it's not going to do that because it can't possibly hike rates enough to break the back of inflation. All it can do is break the economy, which in fact it's already done. It just hasn't shown up officially yet. They broke the financial market. That already happened with Silicon Valley Bank, Signature Bank, the other banks that blew up. The Fed broke them. I mean, of course, that was an accident waiting to happen. It wasn't the rate hikes that did it. It was the rate cuts. The rate hikes just exposed the problem that the Fed created with the rate cuts and keeping rates as low as they did for as long as they did. But imagine what's going to happen in the next leg. Because now that the bond market is breaking down and that yields are moving up, we're going to have a lot more pressure. We had this lull before the storm because the government rushed in with this rescue and bailed out these banks and bailed out the depositors and created this false sense of complacency that the worst was over and that, we didn't have anything to worry about because the politicians and the bankers solved the problem. They didn't solve the problem. They just papered it over as the problem got bigger. And so I think that what's going to be happening is that the dollar is going to break, right? And when it breaks, it's going to break hard. And that makes sense with these exploding budget deficits and trade deficits. And if we get a weak dollar, then again, that's going to put wind in the sail of a commodity bull market, we've already turned the corner on oil. If the dollar weakens, then that's going to further strengthen oil. That's going to put more downward pressure on bonds. And in fact, if we really get a run on the dollar, we're going to get a run on bonds. We're going to get a run on treasuries, because a lot of international investors who want to get rid of the dollar, they got to get rid of treasuries, because that's where their dollars are. They're invested in treasuries. They didn't stuff them under a mattress. They bought bonds. A lot of them bought treasuries. So all that's going to come under pressure. We'll see what happens next week. I mean, I'm very interested to see if we get some significant follow through on last week. I mean, nobody seems to be worried. I mean, I read, quite a few articles, over this weekend, and I didn't really notice any concern. Nobody is really pointing to what happened this week with any sense of concern that maybe this is the beginning of something or the end of something or both. And so I think it's going to be very significant to watch the markets to see if we get a further breakdown in bonds, if we get a big move up in gold, a big move down in the dollar, and the stock market goes down. That will be a good sign that what I just pointed out is accurate, that we've reached a critical inflection point in the markets and things are about to change. And again, that means that people have to get better prepared, that time is running